Good morning, all, and welcome to this morning's video. So, today I have two pairs on watch, and those are Euro Yen and Euro Dollar. So, Euro Yen on watch for me once again. I'm going to break this pair Euro Yen down for you, which is my favorite of the bunch out of the two to date. So, why am I looking at this? As I said, I'm going to start on the daily chart as much as possible just to keep these videos a little bit shorter than they otherwise might be. But when it's relevant to be on the weekly chart, I'm going to start from the weekly chart. Obviously, I've done my top-down analysis at the weekend. Most of my trading work is done at the weekend, not during the week. There's very little to do during the week. Just tailor the entries slightly if price evolves slightly differently to what we'd expected. But the bulk of the work is done at the weekends. And at the weekends, I start on the monthly chart, and then I drop down to the weekly chart, as you would expect if we're doing top-down analysis. But without further ado, so the thing that stands out to me the most is that we have this sharp move up followed by an extremely aggressive sell-off, giving me a clue that there's a lot of liquidity in this area, okay? And that at some point we will likely gravitate towards this area, which appears from my data at least to be an all-time high. Most likely, when a high as this stand out, most likely we will break it before the bigger moves to the downside, okay? And one of the reasons that happens on the higher time frames more so than the lower time frames, particularly when it's a standout area such as this, is because the news media outlets get hold of it and they put out their little news stories or put news in their ticker feeds that says things like Euro Yen at all-time high, okay? And people think it's just going to keep going. So people, when it breaks above, they start buying, especially if they believe what was previously resistance becomes support once it's broken above. They start buying, and then generally speaking, they get washed out. That's why we see that more on the higher time frames, and in particular when we break, for example, all-time highs. On the lower time frames, the media doesn't really get hold of it because it's not as significant. Okay, so then people don't start getting FOMO and think, oh, what if it keeps going? You know, that mentality is not as prevalent on the lower time frames. But regardless, that doesn't mean to say that we can't capitalize on a potentially a shorter term move to the downside in the meantime before we get up to this area. Okay, there's always positions to be had potentially on the lower time frames. Okay, and if we just zoom into this, so we broke above here. Okay, so initially we had this, just to touch on it, seeing as I have a bit more time, we had this kind of structure here, which was parallel in nature. You can see the impulse up. You can see this middle section. Okay. But when we have a correction which is this wide relative to the impulse down which has preceded it, it's less likely that if we get to this area, so for here for example, and we start to sell off, it's less likely that we will commit all the way down to there, for example, because too much volume is built up, meaning that we will likely gravitate back towards that high. Okay, but again, so that may explain why price did not find enough liquidity up here or at that third touch to send it to the downside. And you can see that we've kind of formed an independent structure above here, okay, suggesting there was not enough liquidity here to send price to the downside. So if we just zoom in, what I can see here is that we have, zoom into this piece of the puzzle, we have this high here, okay, we come down, we don't sell off to this low, which just so happens to be the retest of this. We come back up in a very corrective manner. You can see the three drives: first drive, second drive, third drive. We break above, we wick through and not to. So that was a good sign that we were coming to the downside. But again, price had other ideas. It doesn't commit to the downside to, for example, potentially take out the low of this structure, okay, and react from there in some way. It comes back up and it just consolidates. So that gives me a clue that price did not find enough liquidity here to send it to the downside, possibly because of this high above, okay, dragging price up, the liquidity that is there or being placed in that area. But what's giving me a clue now is that potentially This may be the area of value because we've come back up, we've near missed to it, okay? These near misses are often an indication of where the value actually is, okay? But obviously, if we have a high above like that, then we have to be aware of that. That increases the risk ever so slightly. But we near missed, we sold off, we don't commit again, and we come back up, okay? And you can see that this is when we came up here. We have this bullish wick there that will likely get filled. We had a strong weekly close, bullish weekly close last week. If this had a lot of wick beneath it, I'd be more inclined to think this is going to break up higher because that would indicate a liquidity grab of some description. But when it's full bodied like this, makes this more likely that a trade to the downside may be a little bit more imminent. Okay, these are just things that are going through my mind. See, we do have we have to pay attention to that. The wick below there could cause price to break out a bit higher than we otherwise might have anticipated. Okay, but the way I'm seeing this at the moment is that we have this area of value there. We have an area of inflection, the near miss, the FOMO channel, and we have a low here, an exchange of liquidity there, which this low failed to tap into, which was the causation. There was enough of an exchange of liquidity here to cause price to break through this previous high, suggesting that there may be a lot of liquidity here, particularly when we near miss to it. Okay, so that could be a target area. Okay, if I just zoom in a little bit more, we also, as I mentioned yesterday, we have these lower lows and higher highs within the structure. Okay, and then we can see we're moving up in a very corrective manner. If we just look at this wick, okay, so on the daily chart, we had this bullish wick, okay. If we just zoom down to the 1 hour, this to me, what time of the day was that? This to me looks like it may have been some kind of news-based activity. I'm not sure if it was or not, because it kind of reacted from nowhere. Often when they react from nowhere, that gives me a clue. So see, if this had reacted from here, for example, I'd be more inclined to think this was going to push higher. But seeing as this just kind of reacted from nowhere, that gives me reason to believe that was more news-based. I'll have to fact check that to see if that was right. But what I'll be looking for in this instance, okay, is I will be looking for... So I'll be looking for a tap into this area of value, followed by a push down on the 1 hour chart, an impulse down on the 1 hour chart below this area of interest or area of inflection. And then I'll be looking for a consolidation afterwards. That may be a 5-minute consolidation, so 6 to 8 corrective 5-minute candles as a minimum, or it may be, if it is, I will get short with a reduced risk entry on the break as I've drawn it here. It will look something like that. If we get a 2-touch 15-minute continuation, so 6 to 8 corrective 15-minute candles as a minimum, then I would filter this on the 5-minute chart. The first thing I would do is I would look for the same thing. I would place an entry on the break, but I would simultaneously be looking for an entry within the flag like that, where the second touch or the third touch, if it was a 3-touch, taps the first touch, and then I would cancel the original order. Okay, and get short like that. Typically speaking, you get a better risk to reward with those, but whatever shapes up, shapes up. And then what I would do is I would measure from range to range. In this instance, because we also have that higher time frame high above, we may react from these areas and then start pushing up. And the 90% area of a range is typically where we pull back deeply, even if price is going to continue in our forecasted direction. And that would give me, so I would set a take profit there and trail my stop loss accordingly as well, and that would give me a profit of something in the region of 11.5%, depending obviously on the size of the flag, which would affect the size of the stop loss. And that's euro yen. So that would be an example of a low risk position. I would be well positioned if we just zoom back out. By this point, we would be well positioned on the higher time frames for a move to the downside. If we broke above here, broke back in for a move down to this area, we would be well positioned on the lower time frames. The sequence, if it was the first flag and it looked a little bit like that, the sequence would be good. And so therefore, if the market was to take me out, why would it do it? Well, it would be because it was finding liquidity from up there. But again, by that point, if we've broken above here uh, and then broken back below here, and by this point we would likely be below that high there as well, it doesn't make sense for price to then just tag you in and then blast to the upside. If we are going to take out that higher time frame high, by that point, we would likely have, we would likely be pushing down to these lows to take out that, and then this would become the running channel. So we would have this structure here, and then this becomes the running channel to push higher to take out that high. Okay, so we would likely need to tap in. After tapping into these and pushing down, we would likely need to tap into these lows to find the liquidity to actually send this to the upside, and then we would have more of, this kind of structure, which would make a bit more contextual sense. So that is an example of a low risk position, which is why it's at the top of my list. Moving on to a higher risk position in euro dollar. So euro dollar, if we just zoom out. So on the higher time frames, you can see, if we just zoom right out. Actually, let's start on the daily, because we don't really need to. This is an example of where we don't really need to be on the weekly. But we have, price broke above here. Okay, the story as I see it, we had this, a lot of volume was built here, which caused a big run off to the downside. Okay, at least down to that area before it started pulling back sharply. We broke above that, caught people the wrong side of the market, and then we pushed down. And then we have the impulse correction continuations. But then we have this sharp pullback, very sharp pullback, and then another sharp pullback, and then we move down with aggression. Okay, so we have moved down from here more correctively than we moved up. Okay, and when we've actually near missed, I don't think that holds much weight, but when we kind of have this 1, 2, and a potential 3, which lines up with a very sharp move, which caused very aggressive sell-off last time around. When we move down more correctively than we moved up, that there's always a chance that this comes up to there, like that, to give us that 3-touch structure, which would also by coincidence be parallel or fairly parallel in nature. Okay, so that increases the risk, and I shall touch on why as we drill down. But nevertheless, at this moment in time, we've impulsively broke this low, and at this moment in time, we have corrected through it. Okay, suggesting at the moment, at least, that there was not enough liquidity here, where there was a sharp move, admittedly, to send price to the upside. Because typically speaking, if this was what I just drew on a moment ago, we would typically just break below, break back up, get some kind of correction, and then move up like that. Okay, we haven't done that. We've consolidated below or through this low. Okay, suggesting at this moment in time that there was not enough liquidity here to send price to the upside. Okay, and if that's the case, what this could be, if we just measure this impulse, is an impulse correction continuation to push lower. These impulses and the impulse out tends to be of a similar length to the preceding impulse, which would take us down to this area. Okay, so maybe what's happening is that price needs to come down to here to give us this 1, 2, 3 touch structure, to then come up to tap into those highs to give us that. Okay, and then this would become a bit more of a kind of an expanding middle section, if you like, or we just get this overall expanding structure. So that's the thought process at this moment in time. But I'm nimble enough to adapt, or to adjust my sails as the wind changes direction, as it were, if price starts to break above this high here. So we have this high here. You can see I have a feeling, just based on how this structure is forming, that we may push a little bit lower first to give a little bit more of a base before pushing up like that. Okay, but because things may shape up a little bit more quickly than we otherwise anticipated, or or sometimes that happens. What I'll be looking for from this pair today is the following. I'll be looking for price to tap into the area of value. We may come back up and retest the back end of this as well. So you can see that this area of value falls just shy of this. So we may tap into that, but also break slightly above, retest the back end of this, and potentially retest the back end of that sharp move there. And if we did, I'll be waiting for a 1 hour impulse back down, followed by, in this instance, because this is a slightly higher risk position, and because we because we have this kind of angle to it as well, okay, implying that we may push a little bit higher to tap into that area as well. I won't be looking for a 5 minute flag if we push back down. I'll be looking for a minimum, just a tiny bit more weight. I'll be looking for a two touch 15-minute continuation as a minimum, and then I would look to get short on the break or within it, and then I'll be able to manage it down to here for about 6%. And this is where I would actually target these lows because of the momentum that we have to the downside preceding this. Okay, and then that would give us something in the region of, so we'd only have about 5 down to there. That's not typically where I set a mechanical management tool. What I would actually do is I'd measure from range to range there, and I would be looking to target there for about 15%. Okay. But I would be managing quite aggressively as we got to these lows, just because this could be a volume accumulation for a move to the upside, okay, because of what I previously drew on the higher time frames, okay? So am I well positioned? If this was to occur, would I be well positioned on the higher time frames? Well, by that point I would, because we can see this high on the daily chart. We would have likely retested the back end of that, pushed back down into this consolidation. We would have had the impulse down, which tapped into that high there. Okay, we wicked to it, came back up, tapped into that. Everything makes contextual sense. So I'll be well positioned on the higher time frames. I'll be well positioned on the lower time frames. What does the sequence look like? The sequence I've given it using this tool here, I've given it a silver tick because, you know, this sequence to the downside is not massively typical. As I said, there's lots of sharp pullbacks, and therefore, if the market was to take me out, why would it do it? Well, because it may tag you in, tag you out, and then complete that structure. Okay. And then I ask myself, does that look abnormal? It doesn't look abnormal to me. So therefore, this is a higher risk position. So my rules dictate that I will not place this trade unless another trade puts me in profit by 2% for the month. Okay, so that would need to happen, which would likely be euro yen. I do have alerts on other pairs, but if my main focus were the only things to provide an entry, then I would need euro yen to provide me with an entry, which puts me in profit by 2% for the month, for me to be able to take euro dollar. Okay, so that's the reason for this. Is I'm trading personal capital at the moment, but when I decide to apply for funding, this is to protect you from like the drawdown limits and losing your funded account. Okay, so the point being is that if you're not in profit by 2% for the month, let's say you were on a funded account, then you don't want to be, by only taking low risk positions, you're decreasing the risk of you losing your funded account. Okay, so you only start taking these slightly higher risk positions when you're into profit by 2% for the month and far enough away from your drawdown limits that you don't start losing your account. Okay, and a lot of the time it's not the high risk positions that are the problem, it's the psychological aspect of trading, which is a rabbit hole which I don't have time to get into with a few seconds of this video left. But anyway, I hope you've enjoyed this video, guys and girls. I shall bid you a great rest of your day, and I will see you again in the next one. And I will of course bring you another trade recap if I manage to place an entry on either of these pairs. Thanks for watching. I'll speak to you again soon.